Morning, everybody. I'm super excited to welcome Bruce Eckfeldt. Bruce is a strategic growth advisor. He also works with multiple companies when they're trying to exit or expand through M&A structure. Bruce, welcome to our podcast.
Sugata, it's a pleasure. Thank you for having me.
Thank you for joining. So why don't you take a couple of minutes and introduce yourself and some of the great work that you're doing with, mid-market companies?
Yeah, sure. So backstory, originally I was an architect. I got into software. I was kind of doing a lot of computer modeling and animation. Got into software world, ended up founding a tech company back in 2002. We were a early lean agile consulting group. And so we work with a lot of companies on basically product strategy and kind of technical strategy. We did a lot of systems integration, legacy migration work, and then product development work. So kind of cut my teeth on software development methodology, product development strategy. We scaled that company, put it on the 500 list a couple of times. I sold it in 13. And since then have been really focused on advising, coaching CEOs and leadership teams around growth strategy and leadership structure and really how are we going to scale? So how do we go from, a couple million to a couple $100 million in revenue? It's kind of that space that I operate in. And I always kind of joke, half my job is business model, half my job is therapy, really. But working with those teams on how are we going to create a differentiated position? How are we going to operationalize that position? What do we need to do in terms of leadership structure, alignment, performance management, planning? So in one hand, it's high-level strategy. On the other hand, I get my hands pretty dirty in working with them on how do we actually execute it. And it's been fun. I've had a chance to work with some pretty interesting and amazing companies, been part of some pretty interesting growth strategies and challenges, but it's all about really how do we strategically scale these businesses and get to the valuations and the exits that companies are really looking for.
That's pretty awesome. So what's the typical size of companies do you work with?
Generally at this point, they tend to be at least about 10 million in revenue, up to about 100 is kind of where I generally start. And it's really kind of helping them figure out how do we make the big leaps? Usually what I find is companies kind of get stuck at various points. And usually it's because they're kind of holding on to systems, processes, strategies that have worked well for them up to that point, but they've really got to rethink a bunch of things to be able to get to the next level. So it's kind of helping them figure out what that level looks like, what are the changes they need to make, and then just helping make those things.
That's awesome. We're in the tech space. Most of our customers in tech and manufacturing, they sell through a distributed network of partners. Mm-hmm. And when you look at that ecosystem, boomers are about to retire and retiring. So a lot of founders that have built, businesses, incredible businesses over the 30, 40 years, 10, 15, 20, maybe even $50 million services business, they're looking to exit. When I look at partners we have, customers we have. So walk us through a little bit about the framework that if I don't have a succession plan, if I'm not handing it over to a family member to run it, and I truly want to exit, employees are my part of my family. So there's a lot of emotional aspect involved. It's not just a transaction. So walk us through a little bit the framework that you'd use working with a founder that built this incredible franchise, have services aspects of it on both sides, both serving the customers as well as employees. How do you start?
Yeah, it's a great one. I call it the silver wave of companies that are going to come into some type of maturity. Founders that are going to come into maturity or a point where they are no longer interested or able or willing to run the business, operate the business. And it's really kind of a question of the nature of the business, what kind of outcomes they want to have, what options they have in front of them. But we really look at kind of all the different factors, everything from just winding it down in some cases, right? If it's really best just to kind of monetize what we have, wind things down, if there's no real great path for evaluation or a great path for some kind of transaction. But otherwise, we're really looking at a couple of basic options. You can go with what we call a financial exit. So finding someone who is interested in buying companies of your type for basically financial purposes. They see the future income potential. They're willing to kind of put in cash, probably with some debt mixed into it, to be able to finance a purchase, either majority stake or a full purchase. And get the current owner out of the business is from an ownership point of view, may or may not want that owner to stay on for some period of time. From a management and operation point of view, might be bringing in their own management team. In some cases, they're going to be rolling things up into other companies, in which case there's going to be kind of acquisitions into what we call a tuck-in. Sometimes we're looking at what we call a strategic exit. So we find a competitor or someone else in the industry that sees the business that you're operating as a strategic add. It gives them capabilities, gives them access to clients, talent that you have, systems, even data. So in those cases, the transaction is a little less focused on, what is the business doing in terms of top line revenues, in terms of profits, what can I project over the future? And it's more of a strategic fit in terms of they see an opportunity to, combine these things in a way that has future value, but sometimes it's a little more nuanced in terms of how they're going to get that. We then have options like ESOPs, employee management buyouts, right? Like you can do other kind of shifts of ownership, usually over time. There's some kind of process by which the current owner is paid out for their equity, that ownership or equity is transferred to an individual or to a group of individuals that are going to take over the company. There's usually a lot of kind of self-financing. Sometimes they go out and get a loan to pay for that. Sometimes it's just they pay for it through the profits of the company. But all of that really kind of depends on what is the nature of the asset you have, what is the needs of the current owner, and how do we kind of figure out the right plan? Because some of those plans are going to work and some of those plans are not going to work depending on what the owner is trying to do, the constraints that they're operating under, what they want to have next. But it's a process. It's a process to kind of figure out what is there, what are the options, what are those options kind of play out, what are the risks, So it's not necessarily complicated, but it is a bit of a process for kind of discovery. And I would say that a lot of owners haven't really thought about these things. So a lot of what I do is help not only put those options on the table, but really kind of understand what the variables are and what are the questions owners need to ask themselves to kind of figure out which path is probably most likely. And I've seen a lot of owners that assume one path and they get down it and they realize either it's not going to serve them well, it's really not going to do what they want to do. And then we've kind of unwind it. We got to look at other paths.
So let's take two specific use cases,
Yeah.
and we'll roughly take the same size, right? Because they're two very different assets, as you just said. Let's take a $10 million software company, profitable, owner has built it over the last, 10 or 15 or 20 years. It's a very niche vertical solution. So there's maybe fragmented competition out there, but not a lot of growth opportunity. Then you look at a similar size of a services business, which has distributed customer base, but it's very, very people centric. So you have, both pluses and challenges associated with that. So walk us through those two scenarios that, founder or owner, or even the management team said, we'll run this for a while. We can bring it as far as we want. This is possibly better off being someone else's, asset. So what process in those two scenarios you would walk them through?
So let's do the services one first, because in that case, what we really want to understand is where are the strategic opportunities, right? Like the benefits of service companies, I always say, they're kind of easy to start. They're hard to scale, meaning that they don't take a lot of capital requirements to put together a services company. But the challenge is that they're kind of difficult to grow, right? You're dealing with relationships, you're dealing with clients, you're dealing with employees. Like you have to scale. Scaling the business is complicated from getting more of those assets in place. So in terms of a sale, you want to be looking at, if you're looking at a financial potential exit, you need to find, a private equity or someone who's looking at being able to kind of put money into that business. And there's got to be some kind of clear path to growth, right? So that we've got capabilities, we've got talent, we've got people that is in need of, that the market needs, right? So that there's a clear need in the market for additional service in that area. The other key thing that happens on the service side is I have to make some kind of, I have to have some kind of plan or be able to show some kind of capability of being able to acquire more talent. So talent becomes huge in terms of being able to justify growth or justify a valuation based on some kind of growth plan. So that's on the more financial side of services. And I'm going to throw out numbers here and they're all over the place, but generally you're looking at somewhere between like 4 and 7 times EBITDA on some of those things, just because of the nature of the difficulty of scaling. You're not going to see the 10x, 12x, 15x multiples, just because any financial buyer is going to factor in kind of the complexities of scaling the revenue side, but also scaling the talent side. What becomes a little more interesting, I find, on services is if your talent base or client base becomes particularly interesting to another services company. So, if you're, say, 100 people, 150 people, and you've got 1,000, 1,500 person services company out there, and say you deal in logistics analysis and supply chain mapping, like you're a consulting group that has highly expert, has a lot of experts in this space, you're well known, you've got some interesting clients, and they do other enterprise services, they could see your talent pool that you have as being a real strategic add to all of their other clients. So if they have an existing client base, they're going to be like, hey, you've got great talent. I can immediately apply that to all of my customers. I could see a financial gain in the short term because I can leverage that. Or vice versa. If I've got a great client base, they could say, well, I've got a whole bunch of other services I could be selling them, right? So in those strategic cases, the multiples become potentially a little more interesting because it's less about the incremental growth in the company. It's more about, 1 + 1 = 3, and we can combine these services and realize gains. So you might see something more like a 6 to 10x on services if a more strategic exit. The product side becomes a whole different story. Like we're dealing with product, we're looking at, okay, what are the underlying assets and capabilities in terms of software, in terms of technology, IP, data. And again, we can do a financial exit, which is someone who's basically looking at the current company, says, okay, if I put more capital into it, I put in some other resources, how quickly can I grow? But it's basically extrapolating the current business. And there we're going to be looking at all sorts of things like CAC and, what is the lifetime value and what is my churn, right? And those are all things I'm going to use to kind of predict, okay, if I put more capital in the company, how quickly can I turn that capital, additional revenue, additional profits? Ultimately, you're going to have some kind of formula or some kind of extrapolation there because a lot of that is a little bit more responsive, meaning I can grow it pretty quickly. If I just put in the capital, I can put it into marketing, I can get the leads, I can turn those into customers a little bit more systematically and mechanically. I don't have to go hire people. I don't have to go train the people. The software side can see, higher multiples than the service side because of that ability to quickly scale it mechanically. So again, on the software side, we can also have a more strategic exit. Like if I've got a particular piece of data, I've got a particular tool, I've got some software piece that I've worked out that another company could basically acquire, plug into some existing framework or existing customer base and immediately start selling things. That's where we get these really sort of crazy multiples, 15, 20, 25, 30x, because it's this combinatorial effect. It's not just a mechanical, I'm scaling the company. It's if I plug this thing into I take my existing business is $100 million and I immediately double it because of this tool that I bought. That's $100 million of value that can happen very, very quickly. So I'm willing to pay a lot for these companies because of this strategic value. So a lot of what I end up doing is coming in and assessing where are those components, like where do we have underlying assets and capabilities that we could find an interesting market for. And if we can, we find a strategic market where someone is willing to pay an exceptional amount of money for that piece because it fits into some other kind of plan. And that's kind of the art of, doing the strategic exit planning is where do we have those? What might the market be? How do we find that market? How do we approach that market? How do we make the pitch? Right? How do we navigate the complexities? Right? There's a lot of nuance there, but that's strategy, and that's what I love.
So if I take your framework, and we'll separate the conversation into two threads. One would be software, one would be services. So let's take the $10 million services company. And what I'm hearing from you is that maybe I'm grossly simplifying this, but there are really two components. There's an intrinsic value of the business from its ability to generate cash, as Charlie Munger used to say, free cash flow. And then the second is a strategic component that only comes from the acquirer, the person who is acquiring the company. They bring in additional ingredients for it to grow, right? So talk to us a little bit about the services cases where, a $10 million company, US based, roughly about 150K headcount. So with operating margins and everything else, you're looking at someone 45 to 50 people possibly, right? Is that kind of the size we're looking at?
Sounds about right. Yeah,
Sounds
for
about right.
high-level professional services, sure.
High-level professional services. And then EBITDA-wise, in a good, healthy EBITDA, like mid-20s, high 20s? Like
I would say, when I look at companies, like I want to be somewhere between 20 and 30 for a good professional services firm.
Yeah. But the founder is pretty much drawing off the net income. So when you take the founder off and associated expenses off, that's
we call it normalizing the financials, right? Like typically in a privately held company, you've got owner or owners, if you're dealing with a couple of partners, who are essentially passing through a lot of expenses through the company. So they come out as expenses, they're hurting the margin. But it's I'll call it a tax management scheme, right? And a lot of the challenges we want to clean that up, right? We want to have a pretty clean, at least 2 or 3 years of clean financials so that we can go to market showing real margins. Otherwise, we're playing this game of normalization. We're trying to make arguments to an acquirer that says, well, you really don't need to have 2 Porsches going through the company, or we don't need, these other expenses going through. That would really be profit if you own it. You can do it. It's a hard thing to sell.
So let's break that down,
Yeah.
that conversation down, right? Let's say mid-20s, like 25% EBITDA, $10 million company. So from that perspective, if I take an average multiple, let's say 5, as you just said, right? So roughly I'm looking at $2.5 million EBITDA, somewhere in the $10 to $12 million, right? And there may be some debt on the books, some other components that you have to kind of write off or pay off. So there are 2 dimensions. Walk us through the journey that the acquirer will go through, because they still have to put some management infrastructure. They just can't take out. So they're possibly an exit payout for a certain period of time they have to do to make sure the employees don't quit. They have to have some retention payout. So how acquirer is going to typically look at structuring the deal. And then even though the owner thinking, oh, I'm going to get a $10 million check, the reality is, after taxes and payout, if there's no QSBS, all of these other implications. So break us down that scenario on both paths, both from the acquirer perspective and the person that exiting. Yep. How does that play out over a period of 3 to 4 years?
So one of the things that I'll do in kind of the assessment process when I'm working with the company, prepping for exit or pre even thinking about an exit, is start to identify those things that are going to come up in any kind of offer and any kind of deal that it's not going to be a clean deal, right? Clean deal being 100% cash on the table, you walk away, you don't have to do anything else. So, if the owner is intrinsically involved in the business in some way, right? So they're selling or they're operating or, they're actively managing in the company, that's going to create a situation for the acquirer to say, okay, great, I'm interested in buying your company, but you can't walk away, right? Like you are part of the value, or I have to offset the valuation to accommodate the fact that I'm going to have to go out and find another CEO, or either I'm going to have to come in and run it, or I'm going to have to find a CEO, or I'm going to have to backfill some kind of management once you leave. We want to, as much as possible, separate out ownership from operations for the founder, for the current owner, whoever is running the company. So a lot of what we'll end up doing, or one of the things I try to do, is actually get them out of day-to-day management, certainly day-to-day management, even if, moving them into a chairperson role and have professional management come in and run a company. The more that we can create a scenario where the organization that the acquirer is buying is independent of ownership, the better, the cleaner the deal is going to be, and the better the valuation is going to be. Because as an acquirer, I see less risk, right? If you sell me your company and you walk away, that's fine, because the company has been operating successfully without you for the most part. So now, if that's the case, if we can't do that, or if it's the case and we're still trying to go into an exit or a transaction, yes, the acquirer is going to want to put in one of several different strategies to either try to retain you or to try to offset the cost or the risk associated with that situation. And there's a couple of key pieces that, or tools that they will use. So the first one is having some kind of deferred payment, right? So it's going to be a guaranteed payment, but it's going to be some kind of, all right, look, we're going to give you 50% of the company now, or 50% of the value now, and we're going to give you 50% over the next 5 years, over some kind of note, or it's guaranteed payment, but it's not paid right away. With the idea being is they've got some amount of leverage in not having to pay it all at once, or they're going to have to defer. Is basically financing, right? They don't want to have to pay the cash all up front because they're going to have to invest in things. So they basically want to do it as a loan effectively. So that's going to be kind of the first thing they can do. Second thing they can do is they have what they call an earnout, right? Where you're going to have some kind of, so if you say, all right, we're at 10 million, we expect to be at 12 million by the end of next year, 14 by the year after that. They're like, okay, great, but you're going to have to put your money where your mouth is, right? So we say, we're only going to pay the remaining value based on hitting some kind of metrics, right? That could be performance metrics, margin metrics, growth metrics, retention metrics. They could basically take anything that they're worried that might deteriorate post transaction because you're not as interested or you're not involved in the company, and they just tie the payouts based on that. So it basically automatically adjusts the valuation based on what actually transpires post-transaction. The other thing they can do is put in some kind of compensation plan for you to stay in the company. So if you own the company, we're going to do 80% buyout. You're going to have 20% retained equity. We're going to give you, maybe that 80% is on some kind of earnout as well, but we're also going to give you an executive compensation package, which has significant performance bonus components in it that is tied to the goals that you've set for valuation. So they're going to push essentially valuation or push payout into a compensation package. So, and which ones they do and the combination thereof is going to be dependent on the nature of the situation, the nature of the acquire, what they're worried about, what they feel they can offset otherwise. And that's why these things get so complicated, particularly for services company. A lot of what I try to do is get the founder clear on which ones they're willing to consider and which ones they're not. And some people are like, fine, yeah, I'm happy to stay on 5 years. If it's another $5 million, yeah, like, I don't mind working. It's not that I want to retire and go on a beach tomorrow. I just want to know that I'm out of this game in the next 5 years. I like doing the company. I like these owners. I'll stay on. So understanding that and figuring out what parameters an owner is willing to consider is kind of the first step, because then we can drive strategy, we can drive operational performance, we can do leadership to really fit to those options.
But going back, one of the things you said early is that if you're thinking about exit, you don't start now, you start 5 years ago.
Oh yeah, I mean, I always say you should think about exit the day you do your articles of organization, right? Like there should be some kind of plan.
Yeah, and then part of that plan is to build a management team so that the company can be run without you. Therefore, it's valued more, right, structurally and as an ongoing concern. And most of the time, founders focus on control, not so much building a management team, because at the point of exit, it's already too late because you're so built in. The acquirer looks at the structure and say, if I take it out, this thing is going to collapse.
Yeah. I mean, I have this whole presentation I give, going from founder to CEO, right? Which is it's a whole journey that I think every founder has to go through. Every founder tries to go through and should go through at some level, not always successfully. But, in the beginning, you don't. In the beginning, you want to have a lot of control. You want to be able to have, your fingers in the clients and the product, because you're still figuring things out, right? You're still, crafting products and services. You're figuring out value points. You're figuring out how to create, processes. You're creating assets, right? Like you want to be fairly involved, but at some point, you need to start abstracting yourself out of the day-to-day operations. And, usually the first challenge is delivery, right? Like you want to get out of delivery, then you want to get out of operational management. That for services company, I find the biggest thing is sales. Like getting founders out of sales is tough because they're so good. They're typically so good at it. They know it so well. But yeah, ultimately, it's going to make your valuation more complicated and any kind of exit more complicated. I would say, 3 years before you want to do an exit is where you really want to. So if you can show an acquirer for the last 3 years, this company has been running independently of me, that's going to alleviate 90% of the concern for most acquirers in terms of how critical you are to the business. Less than that, you're going to run into this problem. You can say, hey, yeah, I stepped out of CEO role 6 months ago. Company's operating 5. And they're going to be like, sounds good. We still have to play it out. So, for that period, if I'm working with a company and they want to exit in 5 years, okay, maybe we need to be working on this for the next 2 years, but it doesn't need to be a critical objective to get you out of management. But once we get into that 3-year window, that's where we need to start showing a track record to an acquirer that you haven't been involved.
That's pretty awesome. So we'll come back to the discussion of proceeds, how to handle with that and tax and other stuff, because it will possibly be the same to some extent, both software and services. So let's go back to the software scenario, right? Where a $10 million company, maybe growing, 10% a year, not a VC play, may not be even a private equity play right at the bat. Mm-hmm. But it's, it's a good profitable business and possibly higher EBITDA because of gross margin and everything else. Yep. So $10 million, maybe, there's 40 people in the company and pretty much predictable revenue, cash flow.
Maybe less.
Maybe less. Yeah, maybe less, a lot less. So talk to us a little bit about how does that asset look like to a potential acquirer, both from an intrinsic value and strategic value wise.
So, that one, the things that come up for me around those kind of cases. So first is going to be, what is the market that you're currently selling into and what does that look like from a growth and a strategy point of view. So, if you're selling to a segment and you're sizing that segment, say, there's it's $100 million segment. It's not a huge segment. And you have 10% of that segment, a kind of acquirer is going to be like, okay, there's only so much more we can grow here, right? We're going to have to figure out, we have to be able to tell or craft some kind of story of where we can, scale this business in other segments other than the one that I'm currently operating within. And so this is the whole kind of TAM, like total addressable market. Like the first thing they're going to look at is, great, you've scaled effectively up to this point, but where are you going to go from here? And if you're like, hey, this is a $6 billion segment, we only have, less than 1%. It's like, okay, there's runway, right? Like I could see doubling, tripling, quadrupling, 10x this company and not running into kind of a barrier of market to address. So that's kind of the first question. The second question is, we want to look at the current process for acquiring and monetizing customers. And you need to show that I've got the ability to, if I put $1 into marketing, what am I generating in terms of revenue on the other side? More importantly, and this is a subtle one, and it's sometimes tough for companies to kind of wrap their head around or to be able to show and sometimes demonstrate. The acquirers are certainly looking to it, is over time, is the cost of acquiring customer relative to the value of the customer increasing or decreasing? And it's basically net contributing margin, meaning as I grow, am I expanding? Am I growing that margin? Is it staying the same or is it shrinking? And the challenge is if I have a situation where it's shrinking, it's like, hey, I'm growing the business, but as I grow the business, my conversion of customer to profit is decreasing. That's problematic, because a real growth acquirer, if someone's going to acquire this thing with the idea of 10xing it, they're going to look at this and being like, I'm going to be making less and less money. My revenues are going to be going up, but my margins are going to be my percentages are going to be down. My efficiency of my margins are going to be going down over time. And that's a problem. I want to be able to show that as I scale the business, my leverage of marketing dollar and acquisition dollars are going to be increasing over time. That's one of these, print money scenarios, right? Companies are going to look at that. Acquirers are going to look at it and say, great, like I've got $50 million of dry powder here I can put into this company, and it's worth it because as I scale it, it actually gets easier. So that's the real kind of challenge with software SaaS kind of companies when we're looking at growth and scaling, is I have to be able to show not only that I have addressable market, but my ability to efficiently create more margin as I go is proven, is there. And that's where a lot of these ones get sticky, and a lot of founders are like, I want 15x for my business because look at what we've done. And an acquirer is going to look at it and being, yeah, this is slowing down as you get bigger. There's a lot of work to do here. I'm willing to pay X, but I have to leave a lot of room there for either it not working out, or I've got to do a lot of work to figure out how to fix this and increase the valuation.
Yeah. I mean, in the end, both sides, both software and services, it's the discussion of what I put $1 in.
Yeah.
What extra return it generates. So return on that asset.
Well, for the financial, like the other side is if it's more of a strategic, I mean, there may be a strategic buyer that's like, I don't care about any of that, because you have 500 customers that I want, and I may even shut down your services group. I may get rid of all your people and just sell these customers, because what you're selling them, you're making $1 on. I can make $10 on the thing I'm going to sell. So these strategics become, and sometimes you don't even know what they're going to do. Like I've been involved in, one case where, they did the whole deal and we didn't really understand the whole thing until post deal. And then they were like, okay, we get it. Right. And that's why the financial side becomes fairly mechanical. Like you really need to think through, okay, I put $1 in, what am I going to get out? What is the growth strategy? What are the risks? What happens to the operations if I lose the owner? Whereas a strategic, it might be quite different.
So you said from your sort of coaching that you do, there are two components. One is more financial, strategic, that part. Another one is more therapy. So talk to a little bit about, coming back to therapy, the human part of it. When you look at these two types of businesses, whether it's software or services, Do you see certain personality traits that tend to found them? Like, do you see more tech-driven, technical person founding software businesses and more sales-driven or marketing-driven person setting up services, or it doesn't really matter?
I probably attract, in terms of the clients that I end up working with, I do a lot of work with highly technical founders that are exceptionally brilliant at something or exceptionally good at something and have found themselves in a leadership role, ownership role, and are trying to figure out how to scale and then exit the business. So I would say I have a non-standard kind of slice of the market just because of what I end up attracting. Um, and I think the reason is because in those cases, there's a lot of dynamics of, and this is both for products and services, right? So I've worked with product companies, I've worked with people who are brilliant internet security experts, right? And they've created these amazing software products. And I've worked with, exceptional lawyers or accountants or, logistics consultants who are brilliant in what they do. And they are sometimes, best in the world at it. And they find themselves in these ownership leadership positions. And there's this fundamental challenge where nobody can do it as well as they can. But the problem is that they're never going to scale the business and certainly never going to exit the business unless we can build an organization that can do it reasonably well. and that kind of psychological dynamic of how do they let that go? How do they build an organization that still the organization might be best in the world, but not be as good as they are is this kind of challenge that we end up dealing with in many, many cases. And it's really this question of, okay, yes, if you were to do every single project, it would be the best in the world, but that means you can only do 5 projects a year. Whereas if we can build a company that can do a project 80% as well as you can, but now we can do 500 projects a year, right? That's good, right? That's or we need to get to the point where we decide that that is the right thing to do. So there's a lot of this. How do we disentangle egos? How do we understand kind of expectations and dynamics and individuals versus organizations that I deal with? On the exit side, it's interesting. I think the biggest thing I end up dealing with is, most of the times we're talking about amounts of money that would give people amazing lifestyles, right? It's not, oh, well, if I sell at 8x, right? Like I'm kind of somewhat comfortable, but if I can get to 12x, like then I'm really happy. It's like, you're going to be really happy no matter what. So it's really a question is like, what are you going to do with all this? And one of the first questions I have with founder CEOs is, what are you going to do after you're going to sell? And if they don't have a really clear, crisp, motivating plan, I don't do anything else with trying to kind of focus on an exit until we figure that out. Because one of the worst scenarios, and I've seen this more than once, is we get into a sale and we get sometimes really close to signing deals and founders back out because they kind of end up in this position of like, well, I don't know what I'm going to do next. And if I'm not running the company, then now I'm in this ambiguous, what is my life purpose kind of thing. And so they end up not selling. And it could either be directly, they have that realization and they keep it, or they keep finding all of these deal terms that it's like, oh, but I want this and I want that. And if we don't have this, and I want this extra percentage, and they end up killing deals subconsciously because they don't have a plan. So like I'm working on a book right now called Springboard, which is really kind of rethinking this whole kind of exit process to really being a springboard process of like, where does it get you? Like, how do you use this exit to launch you into that next thing? And if we can create that and we get clear on what that next thing is, and that becomes motivating and compelling and a bigger thing, the exit becomes, 10 times easier because now I want to exit, like, because it's going to get me something. And now I get clear on my terms. Now I can go into the process and I can deal with the options. I can deal with the terms very quickly because I kind of know what I want. I know what I don't want. And either it's going to meet those terms, I'm going to do that thing, or I'm not. I'm going to move on. So that's where the psychology stuff for me becomes really interesting, is how that whole founder strategy, founder growth path, what are you going to do? And a lot of times it's not sometimes it's retirement, right? Like I want to go off and do something else. A lot of times it's not. Even for someone who's 55, 60, like they want to go do something else. They're going to go invest. They're going to be an angel. They're going to set up a family office. They've got another company idea they want to put another 5 years into.
So let's go to the psychology piece a little bit more. Roughly about $40 billion went into VC investment last year into AI. More than half of it is in this Bay Area. And we know it's an early stage of hype cycle, and possibly 95% of those companies are not going to make it. And it's a very difficult decision for a founder that started up a company, with major A labels investing in them. At one point in time, as Mr. Wonderful says, you got to take it at the backyard and shoot it, right? Because don't waste your life on something that's not going to get there. Walk us through that scenario. Like, how do you deal with founder or the board? Because board possibly is getting there sooner than the founder is.
Yeah.
That, this is not going to get there. Yeah. How do you, someone like you stepping in and coaching, counseling, and may not be ego, it's a lot of it to deal with insecurity, dealing with failures and how the world is going to perceive. And when you look at a lot of the fundings that going in, people are in their early to mid 20s and they haven't had setbacks yet. So how do you go in there and coach an individual and saying, how do you come to that conclusion that this is not going to get there?
So some of this, we actually had an episode. I have a podcast from Angel to Exit where we cover this. And we talked to the board side of it, and as this specialist that dealt with these situations and VC portfolios of underperforming assets. And it's not even that it's failing. It's like I'll say it this way: if it's clearly failing, it's actually easier because you can kind of look. Right. If we look 12 months out, we don't have any, there's no real prospects, these trends are going this way, like the market's changing, like it's really clear. Like, yes, there's a little bit of, let me hold your hand. We're going to go into the backyard. I'll load the gun for you, and we'll have a little ceremony. Like we can kind of coach them through the process. And there's some psychology around it, right? And it's hard to kind of prep people around it. A lot of it is framing it. You give the, lessons learned. You can kind of prep them a little bit for what they're going to go through. Like, okay, we're going to map out the next year and we're going to spend this time grieving and we're going to go through the whole process and acceptance and you're going to get angry. And like, we can go through those things. The harder one is where it's just kind of limping along. And it really kind of becomes a question of, it's not that we couldn't keep going on this thing, right? Like we certainly could spend another 12 months, 24 months. Maybe there's even some inkling of ideas and opportunities, some like threads we can pull to try to experiment on stuff. But it's really kind of a question of, well, it's an opportunity cost. What is the thing you're giving up by continuing to work on this? And that's usually where the boards kind of come in, depending on your organizational structure and what your cap table looks like and who you have. But if you have a board and they'll be a little bit more like, okay, like we need to get this off our portfolio, right? And it might be, we need to wind this thing down and liquidate it and try to get as much money back as possible. It could be like, we just need to find a quick strategic sale, right? Maybe there's somebody that could buy this thing, at a 1.5 to, valuation, the fund would get their money back, maybe a little bit more, right? But more importantly, it would allow them to reallocate resources. And really for the founder, the role that I play or what I really try to help them do is see like, what else could you be doing? And what else could you be kind of working on, putting your energy into, and kind of see what is the cost of sticking with this thing? How is it affecting your mental health, physical health, professional development? And a lot of times it's that it's not clearly ending, but it's just kind of limping. And we need to really create this vision of like, what is the other thing that they could be working on?
So now looking forward a little bit, 23 and 24 were pretty much down years for exit and investments and for, all good reasons. And it looks like there's a lot of, excitement, whether it's tied to the administration, whether it's tied to where the private equity is sitting with all these dry powder.
Yeah.
What are you seeing from attraction wise? Our kind of founders are waking up early in the year and saying, this is the year. Are you getting more calls this year than you did last year, or where are things at?
It's interesting because I tend to get calls from the companies that are already going and, they're already at, some kind of significant, run rate. So I don't think I've seen it on my side so much on sort of new companies. I certainly have seen last year, there was a lot of wait. A lot of, I'm going to keep my options open. I'm going to keep kind of my resources dry. I'm not going to make a lot of bold moves. And yeah, well, there was the economy, the election, there was hesitation, or maybe people were trying to be patient to the way things play out. I'm starting to see some things move. I think some of it is just pent up, people that should have been doing things before and they were just kind of waiting. And now they're like, okay, it's next year, election's done. We need to kind of catch up a little bit or move. Some people that had resources and they're literally waiting for, we need to kind of see how some of this, economic or regulatory environment stuff is going to shift. I work in a couple industries that are highly regulated. And so they literally needed to wait and see how the regulatory frameworks are going to play out. So I'm definitely seeing people starting to make moves or starting to kind of plan moves. I still think there's a lot of hesitation, right? I think people are still not 100% confident around a lot of things. I think people are taking calculated risks. As much as there's a lot of dry powder, I think that dry powder is being fairly cautious. I'm not seeing the, let's just go for it. Let's spend 50 million on this initiative and we'll see what happens kind of thing. It's much more calculated. Now, it could be the industries that I operate in, kind of the people that I end up working with. But things are at uptick, but it's cautious.
So thinking about exit and actually going through the exit, assuming there's an outcome for the founder, proceeds wise, when do I need to start thinking about this? That, when that day comes, I have to write a check for tax purposes, right? Do a distribution for employees, maybe put away in some sort of a trust for good of the, public or some other initiatives I have in mind. So walk us through that planning framework. When does that need to start? Because by the time you're there, you got to be ready.
Yeah, I mean, so let's there's a couple of different categories. There's the personal side, which is, you can't move to Florida, the week before you close and expect to pay Florida state taxes, right? If you're really kind of personally strategizing about tax impact and tax, optimization and things like that, you need to do that several years ahead, right? Like you need to kind of position yourselves so that whatever proceeds you're going to get, whatever your personal tax liabilities are going to be, that takes at least several years. I think the other thing is really more of like, well, what are you going to do next? And that's why this whole kind of what is the springboard? Like why to think about your exit as a springboard? What is this next thing? Are you going to start another company? All right. Are you going to open a family office? Are you going to become an angel investor? Right. Like understanding that, like having a plan for that will really change not only the nature of the deal you want, right? Like are you taking equity? How much equity do you leave in? How much do you do in cash? What is the nature of this? Is it an asset sale? Is it a, equity sale? Like all of these variables will be different or you'll want them to play out differently depending on what your next step is going to be. So again, it's one of the reasons I ask the question to the founders, like, what are you going to do afterwards? Because that's going to dictate a lot of what the nature of the sale is going to be, the type of sale, the nature of the sale, terms of the deal, and then what we do between now and then to optimize the business and yourself to be able to do that. Without that, you're going to be kind of in the wind in terms of just whatever they give you, you're going to have to kind of deal with. So, from there, kind of figuring out, like, do you want to, even things like, do you want to keep the underlying real estate and assets of it? Like I've had founders that want to keep certain IP, right? They've put IP, they've developed IP that is part of the company or is something they're using in the company, but certain buyers may not want it, or certain buyers might be okay with you carving out use of that IP in a non-competitive market, right? So you may want to actually keep some of those things in different ways. And the same things are for the financial assets, right? Like you want to be able to roll this into another company. You want to invest in something, depending on what you're going to do, we could have lots of different potential outcomes and structures that we put in place. That's why you really want to figure this out. That's the 3 year. My kind of thing is if I can get to a founder 3 years before they are thinking about exiting, okay, we've got some runway to figure these things out. You give me 6 months, there's less things we can do, right? So it's very much based on what are your goals.
This is fantastic, Bruce. So we're coming to an end, and definitely I think we need a second session because today we predominantly talked about founders. And in Silicon Valley over the last 10 years, I've lived here. little more than 3 decades, and I've seen, evolution of these plays. But I think it's really YouTube that brought in sort of a mainstream vernacular this founder mode word.
Mm-hmm.
And I went to a conference last year, is gathering of about 300 founders and investors, and I heard this clear separation of founder mode and CEO mode, and you
Mm-hmm.
alluded to that. And the way founders look at businesses versus how CEOs look at businesses are very different. And that's why very few founders really scale to become CEOs of large companies like Michael
Yeah.
Dell and Jobs and others. So we'll definitely do a second session, but thank you for
Excellent.
being here. It has been, I learned a lot, but thank you.
My pleasure. Thanks for having me.